Nobody who says Bitcoin is going to zero actually believes Bitcoin is going to zero. Not the trolls in the comments section, not the Nobel Prize winners who have been writing its obituary since it cost 11 cents, not even the most famous bears who have publicly declared Bitcoin dead 24 separate times. Right now, there's an investor named Lindsay sitting in a Sacramento parking lot before her shift. She bought the hype at the top, she is 43% underwater, and she has officially stopped telling her family how her crypto portfolio is doing. 1,000 miles away, there's a guy named Dale in western Kentucky running 8 mining rigs out of a converted horse trailer, just sweating over a massive power bill. Neither of them is going to get an honest answer today. Why? Because zero is a comfortable question. It has a comforting answer. The bulls, the bears, and every single person selling you a course or a coin would very much prefer you keep asking if it's going to zero because it distracts you from what's actually happening. Today, we are going to look at the data. We're going to strip away the emotional temperature of this conversation. We're going to look at why Bitcoin just suffered a massive, exhausting drawdown, who is actually selling, and the two massive mathematical threats facing the network that nobody puts on the thumbnail. Let's figure out where your money actually is. Let's start with the drawdown. Half your money gone in a matter of months. But here is the first thing nobody tells you. The crash isn't the interesting part. The interesting part is how it happened. Bitcoin hasn't just crashed, it's crashed violently before. In 2011, it fell 93%. In 2022, it took a 77% haircut. Every previous Bitcoin bear market took somewhere between 77 and 93% off the top. Those were true crashes, violent, fast, and over. But look at the shape of the current chart. The price just walked down a staircase. Step, pause, month after month. Why does that matter? Because a crash produces panic, and panic produces a bottom. A staircase produces something else entirely. It produces exhaustion. It produces that specific 2 a.m. feeling where you stop being scared and start being embarrassed. For 15 years, Bitcoin's price came down to human emotion. Did a large number of individual humans want to buy or sell? It was chaotic, but it was human. Then the institutions arrived, the exchange-traded funds, the corporate treasuries. We were promised that institutional money meant stability, adults in the room. Here is what actually happened. Institutional money isn't driven by conviction, it's driven by plumbing, and plumbing has a redemption schedule. ETF flows now explain nearly half of Bitcoin's weekly price movements. Not sentiment, not adoption, just algorithms and quarterly rebalancing. When the market turns, these funds pull billions of dollars in a single month. But it's not just Wall Street. Let's go back to Dale and his horse trailer. Dale doesn't care about the philosophy of decentralized money. Dale has a power bill. And then there's the third seller, the corporate treasuries. Companies that built their entire brand on the phrase, "we do not sell," suddenly sold. Why? To cover cash reserves and pay dividends. When you line it all up, the ETFs, the miners, and the corporate treasuries, Bitcoin's 3 largest structural holders all became net sellers at the exact same time. Not because they lost faith in Bitcoin, but because of mechanics, electricity, and stock dividends. The panic seller was replaced by a spreadsheet. Now, let's take a deep breath, because if I only give you the bear case, I'm being just as dishonest as the hype channels. There is a website dedicated entirely to tracking how many times public figures have declared Bitcoin dead. It holds nearly 500 obituaries. If you had put $100 into Bitcoin every single time an economist announced it was dead, you would be a multi-millionaire today. It's literally the most effective investment strategy ever devised. Just ignore the economists. The bull case is strong mathematically. Over 14 million coins haven't moved in months. Millions are permanently lost because people forgot their passwords. Coins are effectively disappearing into cold storage faster than the network creates them. Basic supply and demand says the price has to rise. Great, case closed, right? Buy the dip, see you at 100 grand. Except relying on the fact that it always bounces back isn't evidence. That's a base rate. Every single stock or asset that eventually went to zero had a long stretch of years where the people calling it doomed were completely wrong. Being wrong for a long time looks exactly like being early. You can't tell them apart in real time.
So if the risk isn't going to zero, what is it? Even the most committed Bitcoin bears will admit it's not going to zero. The risk is actually a thing that survives indefinitely, maintains a network, but simply never returns your capital in your investing lifetime. And there are two massive structural reasons why this could happen. First, the halving problem. Imagine a bouncer guarding a nightclub. He gets paid a salary from the club, and he gets tiny tips from people coming through the door. Right now, the tips are less than 1% of his income. His salary is everything. But every 4 years, the club cuts his salary in half. It's written into his contract. This is Bitcoin's halving. Meanwhile, the club holds $1 trillion inside. By 2036, that bouncer's salary will be a fraction of what it is today. So one of three things must happen. The value of the currency he's paid in must 8x, the transaction fees must 100x, or the guy guarding $1 trillion network quits because he's not getting paid enough. This is a security budget crisis that nobody has a good answer for. So is Bitcoin going to zero? Almost certainly not. The network works, the computing power is at record highs. But the zero answer is a trap. The bulls love the question because it's easy to win. The bears love it because it makes them sound brave. But while everyone is arguing about zero, nobody makes you answer the three questions that actually dictate what happens to your money. Who is the buyer after you, and what do they have to believe to buy it at a higher price? What has to be true, numerically and specifically, for this investment to work over your timeline? What does not going to zero actually get you if it takes 15 years just to break even? Lindsay went looking for an answer to the zero question. What she found was that she had never once done the math on what would need to happen for her $4,200 to become $8,000. When she did, she realized the price needed to double inside 6 years. Possible? Yes, but she couldn't defend it. So she just wrote the number down and set a date to check it.
I'm not a financial advisor. This is just arithmetic. But you are entirely allowed to look at this market, realize you can't honestly answer those three questions, and simply choose not to play. Sitting out is a position. It has a return, it has a risk profile, and it doesn't require you to be right about quantum computing. If you can answer all three of those questions out loud, without flinching, to someone who actively disagrees with you, then you don't need a YouTube video to tell you what to do. That's the test. Everything else is just somebody's story about why the next buyer is going to show up. Thanks for watching.